Hello everyone and welcome back to another financial planning video. My name is Erin Varghese and I am a financial planner here at Pure Portfolios. So we know that compensation can come in many different forms. So today we are going to be covering the executive compensation of ESPPs or Employee Stock Purchase Plan. So before we get started, please keep in mind that this information is intended for educational purposes only. And if you need individual advice, please consult a legal, tax, or financial professional. Okay, so what are we going to be covering today? We know that employee stock purchase plans, or ESPPs, allow you to buy shares of a company stock at a discount with after-tax dollars. So today we're going to be going over the basics of ESPPs and what the ESPP cycle looks like from start to finish. So what is an employee stock purchase plan? ESPPs can be thought of as a form of compensation. This is in addition to your salary, it's an additional benefit offered by your company. So it's a company-run program that allows you to buy shares of company stock at a discount with after-tax dollars. The benefits of an ESPP program is, of course, that you're able to purchase stock at a discount. You can also fund your short-term goals with this benefit, and you can also save for retirement or other long-term goals. There are a couple of drawbacks, and that comes really in the form of the complexity of it. There can be complex tax rules, and you can also have the potential for a concentrated position really quickly if you're not monitoring the size of your ESPPs or the other assets that are in your portfolio. So we always stress to our clients that you don't shy away from ESPPs or other stock option compensation type programs just because they're complicated. We do want to understand everything that we're investing in, but we don't want to shy away from it simply because it may be complicated. So make sure that you understand what your investment options are so that you can make an educated decision based on your personal information. Okay, the ESPP cycle. So the first part of the three-part cycle is the enrollment and offering date. So we say the term enroll because if you're offered the option for the ESPP program, you have to decide to participate. So in order to participate in the ESPP, you enroll in the plan and decide how much of your salary you want to contribute. So your company will end up setting up an ESPP account and begin to deduct a portion of your salary to set aside. So just keep in mind that all of these deductions are post-tax. So when you look at your pay stub, you'll see all of your pre-tax deductions. That could be things like your 401k contributions, health insurance, transit benefits. Then you have your taxes that are set to pay taxes at the end of the year. And then you may have some post-tax contributions. That would be like your ESPP contributions. So all of these deductions will go into an account that your company has set up for you. Now we get into our next piece of the cycle. So this is the enrollment period and purchase period. So as the weeks go by, each paycheck, that specific amount that you elected for during the enrollment period will be deducted from your paycheck, again, post-tax. And this amount will just start to accumulate over the weeks. And then at a specific date, it's usually twice a year, shares will be purchased by your company. So we get to our last piece of the ESPP cycle. We refer to this as the transfer phase. So after your company buys shares of their stock, they will end up transferring those shares to you, much like you would hold stock in a brokerage account. Now keep in mind there's no taxes due when you purchase the shares, it's only when you sell. So now that we know the basics of ESPPs and kind of how they work, what the cycle looks like, we know that company shares are bought at a discount with after-tax dollars, but how is that discount actually determined? Depending on the company, it's usually 5 to 15%, but the discount is almost often applied in one of usually 3 different ways. So first, they may apply the discount to the lesser of the fair market value at the beginning of the offering period or the purchase date. They may also apply the discount directly to the purchase date price, or in some cases, they may apply the discount to the lowest closing price of the stock during the purchase period. There will always be some combination of these situations. It's typically built into the ESPP plan when determining what price the company stock is going to be acquired at. So you may have noticed the term look back on one of our previous slides, but the look back option is the discount that applies to the lower of the 2 prices, either the stock price on the first day that you began to set money aside or the stock price on the day of the purchase. So in our real world example, our case study today, we are going to be applying a 15% discount with a 6-month look back. So here's what it looks like in action. Let's say you had an offering date of June 1st. The stock was trading at $15 a share on that day. Now it's December 1st, and the stock has appreciated in value by $5 a share. It went from trading on June 1st at $15 a share, now it's $20 a share. This look back means that you are going to be purchasing a stock that's trading at $20 for $12.75. So how did we get there? We're going to look at the lower of the two prices. So we're going to look back to June 1st because that's when the stock was trading at a lower price. So that's where we're going to take our discount. So we're going to take our $15 a share, we apply our 15% discount, and we receive $12.75. So immediately we have an unrealized gain of $7.25 on each share that we have purchased. So now you may be starting to see how this is a good opportunity to purchase stock in your company at a discount, and it can be a great way to build wealth. So if you are offered the opportunity to participate in some kind of executive and equity compensation, it can be kind of challenging, especially when taking into consideration taxes and the complications of income planning. But you have to understand the packages that are available to you and everything that comes along with them so that you can begin building a tax-efficient plan that addresses your needs and maximizes your benefits. So thank you so much for listening. If this is a program that's been offered to you and you have questions or just need advice, don't hesitate to reach out to us. All of our contact information is listed below. We'll see you in our next financial planning video. Bye.